We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Adam Hamilton, founder of Zeal LLC.com. How are you today, Adam?
Great, Tom. Thanks for having me. How are you doing this morning?
I'm excellent. It's good to have you back. It's been a little while since we've chatted. And of course, before the call, we're speaking a little bit about spring being here. And that kind of brings me to the first point that I wanted to talk to you about is let's say the seasonal nature of this time of year, and if that brings momentum into the gold sector and where that momentum takes us in terms of timing.
Great question, Tom. Seasonals are a big part of gold. And it's kind of funny because I grew up in rural North Dakota in wheat country. And, you think of grown commodities for seasonality, wheat, corn, soybeans, and gold, the production is fairly steady year round. There are some minor quarterly dips, but in gold, demand fluctuates massively at certain times in the calendar year. There's actually three big seasonal rallies in gold: a spring, autumn, and winter rally. And the spring one is actually the weakest rally in gold, going over like 20 years of gold bull years since 2000 or so. But spring is the strongest seasonal rally for the gold stocks. And for other seasonal rallies like winter and autumn, there's well-known causes. Like the autumn rally, you have Indian harvest, Asians buying gold after they see how much surplus income they've earned for the year. In winter, you have holiday buying, boyfriends, husbands buying jewelry for their wives, Christmas gifts. Then you have Chinese New Year buying after that for the tail end of the winter rally. But spring rally, there's really no obvious cultural driver from around the world. And Tom, I think it's just optimism, man. I mean, you live up north. I grew up north, and the daylight gets longer, the sun gets there. Everybody's excited for spring, excited for summer, excited for vacation season. And I think when people are optimistic, they want to buy more stocks. And so gold stocks have their strongest seasonal rally of the year relative to gold from about mid-March to late May, early June. And we're right in the middle of that span. And gold stocks are doing awesome this year, as you know. It's fantastic.
Mm-hmm. So, yeah, does that momentum end up taking us, like you said, in the metals as well as the miners into about that mid-May period?
Yeah, mid-May to late May, sometimes early June. Every year the seasonality alters a little bit, depending on what happens. Mm-hmm. Last year, 2022, there was a big gold sell-off in mid-April. The dollar started going parabolic when the Fed started hiking rates like crazy. That's when the Fed officials started promising bigger than 25 basis point rate hikes. And so gold fell sharply last April, which is very atypical. So sometimes there can be exogenous events that kind of shock gold and gold stocks out of their normal spring rally kind of momentum. But if there's nothing like that, they should continue into late May for sure. And it might even go bigger this year because there's a lot of good bullish fundamentals behind gold and gold stocks this year as well.
Mm-hmm. Yeah, it's going to be interesting to see what happens this summer, as gold typically enters a very kind of doldrum phase in the summer, but we'll see what happens with the miners and the metal this year with, as you say, so many positive factors behind it. But Adam, I wanted to talk to you a little bit about what would indicate to you that gold or the miners are getting into an overbought condition, and would that signal a sell or just caution at this point? We've seen a very fast rise, a very, very optimistic gold buying. So I want to kind of dig into a little bit about what would signal caution for you at this point.
As a speculator, man, I'm always looking for overbought, oversold conditions. And that's a huge concern after a fast rally, as you pointed out. The thing I mainly look at, Tom, is overboughtness and oversoldness is really a sentiment thing. People get too greedy after prices go up too fast. Mm-hmm. And the problem with that is it sucks in all available near-term buyers too fast. Everybody who wants to buy into gold stocks and gold has bought in, and so there's no new buyers, and so therefore the price starts dropping. That downside momentum kind of cascades into a pullback or correction. The thing I look for overboughtness is this concept I call relativity. It's very simple. It just looks at a price relative to its 200-day moving average. You need some kind of baseline to define overboughtness and oversoldness. And the 200 DMAs are nice because they follow prices, but it's gradual. They distill out most of the volatility, yet they still show longer term trends. And so I look at the distance, both gold and gold stocks per GDX, the leading gold stock benchmark, are stretched above their 200 DMAs for overboughtness. And they're definitely overbought. I wouldn't be as comfortable buying today as I was back when both gold and gold stocks were under their 200 DMAs. That was mostly back in last November. in late September, but also in March, early March, gold and gold stocks got hammered pretty low. Gold didn't quite go below its 200 EMA, but the gold stocks did, GDX did. But so Tom, I look at a 5 calendar year range for this relativity concept. And if gold is stretched more than 16% above its 200-day moving average, that's time to be cautious.
Mm-hmm.
And that's time to be cautious in gold stocks as well. For GDX, the line for overboughtness, for extreme overboughtness, is 1.35 times, 35% above its 200 EMA. And gold stocks have been as high as 25% in this past week, and gold's been as high as maybe 13, 14%. So it's definitely good to be cautious here. I wouldn't sell. We're right in the middle of the spring rally. There's a lot of great fundamental reasons to be long gold, like this raging inflation around the world. I would just consider ratcheting up stops. When we get to that level of overboughtness that causes concern, if you have a 20% trailing stop loss, ratchet them up to 15% trailing or 10% trailing. And so what I generally do is just gradually ratchet up my trailing stop losses. That preserves more of my gains for when that pullback inevitably happens. Mm-hmm. And so that's worked really well in the past for us.
Interesting. So Adam, some of the fundamental factors like you've mentioned, touched on loosely here are, let's say, the policies of the central banks. And you recently wrote that the Central Bank of Australia and Canada have paused their rate hikes for now. So does that put pressure on the Fed to do the same?
I think it does. And actually, the Reserve Bank of India is the third bank that did this in the past week, did a pause. All three banks are saying they're pauses, not pivots. They want to see the impact of their huge rate hikes over this past year, what they're going to do to their own economies. But I think it absolutely pressures the Fed. The Fed has hiked 475 basis points off zero, mind you, in 1 year, which is it's crazy. It's unprecedented. It's the most extreme tightening in the Federal Reserve's history. That central bank was founded in late 1913. So that's a long history. And the Fed's causing huge problems in the economy all over the place with these crazy rate hikes. Silicon Valley Bank last month went bankrupt essentially because of a run, because people were worried about unrealized losses in its portfolio of short-term U.S. Treasuries, mm-hmm. considered the safest investment in the world as far as bonds and stocks go. I mean, as a gold guy, I disagree with being the safest investment, but as far as like conventional thought, mm-hmm. I read an article this morning talking about the interest payments the U.S. federal government is paying, and they're annualizing at $800 billion right now, all-time record, and they'll be over $1 trillion annualized later this year. I was talking to a friend this weekend at one of my kids' basketball games, and they have a paid-for house, but they have a home equity line of credit, small percentage of their total value of their house, but mm-hmm. their interest payments over the past year have quadrupled just because of the Fed rate hikes. And so this is really hitting ordinary people, and it's really slowing down the economy. And the Fed risks pushing us into a severe recession, if not a depression, if it keeps hiking. And I think the other central banks, the Canadian central bank, the Australian central bank, taking the lead in that, absolutely puts pressure on the Fed to kind of just stop, pause, reconnoiter, see what the impact is going to be. All those central bankers say that monetary policy works with a multi-quarter leg, 3 quarters, a year, 5 quarters. And so we really don't know what's going to happen yet to the economy. There's going to be things like Silicon Valley Bank that people don't foresee happening. And so I think that absolutely pressures the Fed, Tom.
Mm-hmm. Yeah, as you say, the lags with which that monetary policy affects the economy and everyday people, never mind, companies having to roll over their debt. I was speaking with a company owner the other day, and he was telling me that as he needs to refinance, let's say, mortgages for his commercial properties, it's really starting to put a dent in his bottom line. And he doesn't know if he's going to be able to keep refinancing those, keep rolling them over at this point. And as you say, those lags are an important piece to consider. But, something maybe we can kind of pull this apart after, but, you bring up jobs data in your most recent article, pressure from the other central banks alongside these bank failures that we just talked about. So what do you think the path forward looks like for the Fed from here? What are let's say the percentage, what the market is expecting from the Fed at this point?
In the federal funds futures market, the way those futures trade, it always implies rate hike odds. Mm-hmm. And the next FOMC meeting is early May. I think like the 3rd is the day they give their decision, maybe the 2nd. But the market implied odds for that, Tom, are up around 75-80% for a 25 basis point rate hike at that next FOMC meeting in a couple of weeks. But they've been as low as like 40%, depending on economic data. My best guess, my gut feeling is the Fed will hike one more time, since they've kind of implied they would, and then they'll pause after that. Mm-hmm. But yeah, they're getting to a point where they're really restricting the economy, and it's going to cause huge problems that are difficult to anticipate. And the central bankers are starting to feel the pressure on that. So yeah, I think one more quarter point hike in a couple of weeks than done is my best guess.
Mm-hmm. And of course, the last time you and I spoke, we talked about the behavior of gold in these rate hiking cycles. Do you think that this pause, the market is going to look at it as a reversal by the Fed, or, what do you expect for let's say the net effect in the gold price from the Fed pausing, if that's what happens?
Yeah, it's a great question. I've been thinking about that a lot lately. I think traders will absolutely view that as a pivot. The Fed will say it's not. The Fed will say we're just going to stop here for a while. We're going to hold rates steady, but traders are just perpetually optimistic. And this has been such an extreme hiking cycle. So I think the stock markets will rally pretty hard. If the Fed signals, like the Fed can hike 25 basis points in 2 weeks, but not signal, that's going to put things on hold for a while. But if it has that signal, either in Jerome Powell's press conference or else in the FOMC statement itself, I think that there'll be a big rally in stocks. I think the US dollar will keep falling, which will boost gold. The main mechanism through which Fed rate hikes and cuts affect gold is via the US dollar. Gold futures trading dominates the short-term gold price, unfortunately. Those guys run crazy leverage, like 25 times leverage is normal. So if the gold price moves 4% against their positions, they lose 100% of their capital risk. It's just insane. And in the US, the legal limit in the stock markets has been 2 times since the mid-1970s. So running 25, 30 times leverage in gold futures is crazy. So these guys have to be ultra short term. I mean, they can only care about the next hour, maybe next day, maybe a week if they're really long-term futures guys. But so they see the Fed hike or cut or signal that they're going to do one or the other. And the US dollar moves accordingly. If the Fed's hawkish, the dollar rallies. If the Fed's dovish, the dollar falls. And the gold futures guys fade that and do the opposite. And so what really will affect gold at the next FOMC meeting is what the dollar does. The dollar's been falling, but it went parabolic in the middle of last year, as you know, Tom. I mean, a lot of pain in Canada with the US dollar going high, at least for traveling down here. And so I think if the dollar keeps falling, which it should, it's in a bear trend. It's still relatively high relative to the past several years. Then gold will definitely get a boost on that.
So, Adam, the Fed seems to be relying really heavily on jobs data to make its decisions around. How accurate do you think this data is?
Oh man, Tom, that's a really interesting issue. I'm glad you brought that up. Jobs data for a long time, for the decades I've been doing this, it's been the most important market moving report, the headline US monthly jobs report. We call it Jobs Friday, usually the first Friday of a month down here, sometimes the second Friday, depending on how the survey week falls. There's a couple surveys that go into this monthly US jobs data. One is a survey of households. That's a pretty big survey, pretty deep survey. They just call ordinary Americans, say, hey, do you have a job? And the other one's a survey of employers, and that feeds the headline non-farm payrolls number. But jobs has been really interesting because most economic data in the US is weakening. You look at other series, inflation's been raging out of control, the CPI, PPI, I know Canada's been the same way. So the Fed's really been relying on jobs, and the organization in charge of the jobs data in the United States, the official jobs data, is the US Department of Labor's Bureau of Labor Statistics. And in the 25 years I've been doing this professionally, it's always had a reputation of being a highly politicized government agency. The people in charge of that, the statisticians, they tend to, it seems like they're influenced by the party in office, the party holding the presidency. The executive branch of the United States is in charge of the bureaucracies, the agencies, including the Department of Labor. And for something like 10 of the past 11 months, Tom, there have been big upside surprises in monthly US jobs as of one report ago. This latest report was in line, but that's been a big deal because almost always in the Feds, I read every FOMC statement when the Fed releases it. I watch all of Chairman Powell's testimony live after every meeting because it moves markets. And the Fed guys just cite jobs. Jobs are strong. The economy's strong. Jobs are strong. Jobs are strong. Jobs are strong. But that data is really suspect. There's a lot of other jobs data series, private data series. One example is there's this company, ADP, used to be automated data processing. They do huge amounts of payrolls across the United States. They have their own data series that's released a couple of days before the monthly jobs reports. There's another data series called WARN notices. There's this legal act in the United States where if you're going to lay off workers, mass layoffs, you have to report them to the government in advance and tell your workers. There's another set of data from states called weekly jobless claims. They come out every Thursday morning. And anyway, all these data sets for jobs are showing sharp slowdowns over this past year, Tom. But this one BLS monthly jobs report that really moved markets, just huge growth. back in early February, gold started falling in a sharp pullback, as your listeners know, and it plunged like 4.4% in 2 trading days. And the lion's share of that drop was the morning after a monthly U.S. jobs report. And that jobs report was crazy. It came in at an 8 standard deviation upside surprise. So statistically, I say statistically impossible, 0.000 whatever percent chance of happening normally. But the U.S. Department of Labor said that the U.S. created 517,000 jobs that prior month, but the actual jobs were minus 2.5 million. And that's per the raw data in the BLS's own report. That same report showed minus 2.5 million. So they created a 3 million job seasonal adjustment, 3,022K job seasonal adjustment, the biggest seasonal adjustment ever to get that big upside surprise. And that was really suspect because that happened, Tom, like 3 days before our president was going to give his State of the Union address. And in that State of the Union address, which I also watched live because it moves markets, he talked about how awesome the labor market is, how strong jobs are, because that's one of the only things the administration can point to as being good. But that data is highly suspect. And that's moving gold. It's moving the dollar. It's causing the Fed to hike 475 basis points. And that's a huge problem because of the far-reaching real implications to the U.S. economy of all that hiking. If it's based on a false premise that the jobs market is way stronger than it truly is, I think that's scandalous in my opinion.
Mm-hmm. Well, it makes me wonder how this job data is being calculated. I've spoken to other analysts that think that, let's say, if you lose a full-time job and you replace it with 3 part-time jobs, that counts as, plus 2 jobs. So is that a possibility for, can somewhat account for how that statistic is calculated?
That's absolutely a factor. That's a great point. And the BLS has series for multiple job holders, and that's been rising a lot. Another problem with Tom is when people lose their jobs, like say someone's been working for a decade plus someplace, they usually have a pretty good compensation package, but they might have to get a lower paying job or 2 lower paying jobs. The job beats in the past year, it's been kind of a waiters and bartenders thing. There's a subcategory for like food services, and that's one of the big growth categories. And God bless those people, but those jobs generally don't pay a lot of money compared to like being a professional.
Yeah.
And so, if you lose an office job and you have to go serve burgers or something or flip burgers, I mean, you're way off economically than you were before, especially if you have to have 2 or 3 jobs to just try to make ends meet. And I think that BLS data is skewed by that multiple job holder category without a doubt. So that's a great point.
Yeah, I was going to bring that up, is the idea that you're not only losing, let's say your hourly rate remains the same, but if you're replacing that full-time job with 2 part-time jobs, you're not necessarily getting the same benefits on the side or the back end, which affects your spending in the economy as well, right? If you need to now purchase your own health insurance versus having it mostly covered by your employer before that, that's a huge lag on that chunk of your capital that is available every month, right? Your disposable income.
Oh, absolutely. Absolutely. That's the biggest, I've been a small businessman for 25 years now. Well, 24, almost 25. And I know a bunch of small business people, and health insurance is one of our biggest fears in America. That's one of our biggest expenses. And it's, we can't really control it. We just got to pay it. And it goes up, 20% every year, no matter how healthy you are, which is really frustrating. But yeah, if you lose those benefits as well as losing your salary, you're in a world of hurt, and everybody's lifestyle is set up to match their income. That's just the way we humans are. If we make X, we live up to X plus 5% or whatever. And so, if you have a 50% cut in your compensation, the lifestyle implications are just massive. And the spending implications, as you said, just reverberate through the whole economy when that happens, when someone with a good job has to take one or more lesser jobs or lower paying jobs to try to get by. It's horrible.
Mm-hmm. So, we've been talking about these job statistics. What's the difference between that and the JOLTS data?
Oh, great question. So the monthly U.S. jobs report's the big one that moves markets. And for the first 15 years I was in this business watching the markets, no one cared about JOLTS. It stands for Job Openings and Labor Turnover Survey. And the same Bureau of Labor Statistics actually produces that data series, Tom. And it's weird because it's published with a 1 month lag. So it's 2 months in arrears in effect, rather than 1 month back, like the monthly jobs report. But when traders are looking for more data on jobs or to corroborate the big monthly U.S. jobs report, they've been increasingly looking to JOLTS. And that JOLTS data has also been incredibly strong, showing like high number of job openings in the US over the past year when the Fed's been hiking. That implies that business is robust. Therefore, people are looking for workers and they're willing to pay more for workers. And so these JOLTS beats have been feeding into kind of this, they help drive the US dollar parabolic over this past year. And then I don't know, like 17 of the last 18 or 18 of the last 19 JOLTS reports were upside surprises, Tom, and the markets reacted accordingly. But this latest one reported was incredible. It was like a huge million job miss. We're talking like 10 million job openings plus or minus 500,000. And there was a million jobs missed that just shocked the markets. And the dollar fell hard in that, gold rallied hard in that, because that implies that the job market isn't as strong in the US as people thought. Therefore, the Fed won't have to keep hiking rates, or will have to pause, or will have to pivot before long. Another thing, Tom, I don't know if this really fits in, but circling back a little bit, I was reading last week a study by some economists, and they said that the average length of time between the last cut of the last hike of a hiking cycle, and the first cut is like 6 weeks. So that's one FOMC meeting. So traders know the Fed's been saying higher for longer, higher for longer, higher for longer for a whole year. We're going to get rates up high. We're going to hold them flat for a long time to slow down the economy, to slow inflation. But history says central bankers have a really tough time holding rates high. They jack up rates. The economy starts to roll over into recession. They don't want to have a severe recession on their hands. They take a huge political blame for that. So therefore, they start cutting generally pretty soon after the last hike. So when traders think that last hike is in, they're going to expect cuts, whether cuts are going to come soon or not. I think that's a factor as well. One more thing about JOLTS in the BLS surveys. The BLS publishes the response rates for their surveys. These reports are voluminous, long, dozens and dozens, sometimes over 100 pages long. I try to parse them. I don't understand them all, of course, but they have a survey response rate in there, Tom. In the JOLTS survey, the latest response rate is a record low. It's running around 31%. So for every, 100 calls the BLS makes, only 30 people respond, 31 people respond, 31 businesses. And so effectively 2/3 of that data is estimated or made up or fabricated. And so that data is really suspect. And the survey rates and the monthly US jobs reports are dropping as well. Both employers and Americans just don't want to talk with the government as much as they used to. And so that jobs data is highly suspect as well, because the amount of people responding to the surveys is way lower than it was in the past. And so anyway, food for thought.
Yeah, absolutely. As you were explaining that last answer, it makes me think about, the idea that the Fed is just responding, or needs to start cutting right as soon as they see the economy start to roll over. I speak to some people and they say, oh, Powell has done exactly what he laid out, what he said he was going to do. And then thinking about, it seems like the Fed is reactionary here. It makes me appreciate the nuance in these discussions of how the Fed needs to react and the timeline that they're also acting upon. It really seems like the idea that they have this dual mandate of, needing to keep employment high, they've been signaling to the market that they need to destroy demand, which means, in other words, destroying jobs. So it's such a hard thing, I think, to, let's say, keep those two ideas in your mind simultaneously.
Yeah, absolutely. The dual mandate's crazy. I don't think it should exist. I think price stability is much more important than anything else. And inflation is just a consequence of too much money in the system. When central banks print more fiat money, if the supply of fiat money is growing faster than the underlying pool of goods and services in which to spend it, that money will compete for and bid up those prices on goods and services. Mm-hmm. And so that's what the central bank should be concentrating on, keeping their money supply growth. I think it should be zero personally, but at least low, at least, sub 2%. And then they wouldn't have to worry about the jobs picture. The economy would take care of itself. And you could argue that central bank shouldn't exist at all, that the price of money should be set by free markets. I would advocate for that also. Mm-hmm. But yeah, that employment thing is really tough, especially if this data is not as good as people think it is. Mm-hmm. One problem we all have as humans, we think that if we see a number, it's precise. I heard a joke on CNBC last week. I thought it was funny. It was something like, how do you know economists have a sense of humor? Because they use decimal points. I mean, they estimate everything, right? I do it too in my writings. I like to go down to decimal point, like 0.1%, which is silly, but we just don't know. And if this data is suspect and it's not comprehensive and it's estimated and it's seasonally adjusted and it's massaged, and central banks are doing rate hikes based on this, and it can't lead to a good place, I think, Tom. It's really, really troubling to me.
Yeah, I think anybody that's paying attention feels the same way. But Adam, one of the other price drivers for gold, as you recently pointed out, was the positioning of traders. And of course, now we have that data again after the hack and the issues with the commitment of traders reports. So how is the positioning of the shorts and longs affecting the gold price right now? And where are those two positions kind of sitting?
Oh, great question. So gold's sharp pullback in February, 7-8%ish. That was all futures selling. And gold's entire rebound since early March. That actually started before the Silicon Valley Bank failure, by the way. It started, I don't know, 4 or 5 days before that. And gold already had some upside momentum before that event. And there was also a Jobs Friday the same day that bank was going under. But anyway, there's been huge futures buying, huge speculator buying since early mid-March, Marchish. And one way I like to look at speculator positioning is the commitments to traders reports are complex. They're voluminous. There's a lot of data. They have categories that are difficult to understand. So what I do is I look at the speculator positioning, both large and small speculators, and I look at it as a percentage of its past 52-week trading range, Tom. And I find that really useful because it just helps me distill down quick where things are. Ideally, the most bullish situation for gold is 0% long. Speculators are down to the lowest level of longs in a year and 100% shorts. That means that they probably can't do much more selling. Their longs are down about as low as they're likely to go. Their shorts are about as high as they're probably going to get. And that's where the futures positioning was back in late September 2022 and almost again there in early November. It got down pretty low. Like longs are more important than shorts because longs outnumber shorts by 2.5 times on average. And so spec longs got down to about 4% out of that 52-week trading range back in early March. And that was wildly bullish. I was writing like crazy on that. Our trading books were full since last fall, but we were adding positions where we got stopped out, taking advantage of those really cheap just gold prices. But this latest COT report I saw last week, total spec shorts are back down to zero or near zero, 4-5%, Tom. And that means that specs have done about all the short coverage buying they're likely to do. And that's fine because gold uplegs have 3 stages, stage 1, stage 2, stage 3. The initial stage is speculator gold future short covering buying. And that's got to propel gold long enough for high enough to trigger stage 2, which is speculator gold futures long buying. And spec gold futures longs last report were about 50% up into their past year trading range. So they're not at zero, which is the most bullish, or not 100%, which is the most bearish. They're right in the middle. And since we have the strong upside momentum in gold right in the middle of a spring rally, I think that speculators will add a lot more gold. As we get closer to 100%, though, people need to be cautious and start thinking about ratcheting up those stop losses because that speculator buying is finite. And if it doesn't push gold high enough for long enough to get investors, which is stage 3 buying, to start buying, they command vastly more capital than the speculators do, the gold future speculators, then this gold upleg is going to peter out. Not the bull, just the upleg. And so we watch that. All my newsletters, I talk about this stuff. It's really important for gold's short-term direction.
Yeah, absolutely. So, in that third leg, as you're calling it, is that the institution starting to take notice and rebalance their portfolios as well, considering, or institutions and or hedge funds rebalancing when they see that gold has been beating, let's say, some of the other sectors?
Absolutely. As human traders, investors, speculators, we all love chasing momentum. We like to buy things that are already going up. It's really hard to be contrarian, as you and your listeners know. I mean, it's hard buying low when sectors are hated, like gold stocks back last September. And so people just love upside. They love momentum, and that includes investors. That includes professionals. And as you alluded to, they have benchmarks. They need to outperform their peer group, their whatever they track, whether it's the S&P 500 or whatever. And so when they see strong gold rallies, they tend to buy. And so they're the ones who lead the vanguard of investment buying, and eventually individuals start coming in as well. One metric I find interesting, Tom, is I try to figure out what percent people have invested in portfolio and of gold investment in their portfolios right now. And it's crazy low. It's vanishingly low. One ratio I've used to do that is there's 2 big American gold ETFs, GLD and IEU. They're the lion's share of all the gold exchange traded funds in the world. And if you look at the quarterly gold demand trends reports in the World Gold Council, which are the best source of gold fundamental data, the change in GLD plus IEU physical gold bullion holdings tends to track the actual global gold investment demand changes really closely. And GLD plus IEU, if you add up the value of their holdings and divide that by the total market capitalization of the 500 S&P 500 stocks in the United States, that ratio is like 0.2%. So that implies that the average American stock investor has way under 1% of their capital allocated to gold. There's a bunch of assumptions that go into that, but just, to get a quick, kind of sense of where that is, it's virtually zero. And so I think there's just huge room to buy gold. And I think a big catalyst for that, Tom, will happen when people realize that 475 or 500 basis points of Fed rate hikes are not stopping inflation. For a whole year, the Fed officials, central bankers all over the world have been saying, hey, if we hike rates, inflation will fall via that demand destruction mechanism you talked about a couple points ago. But inflation is a money supply issue. It's not the rates aren't the problem. Like, if you look at the average CPI inflation in the U.S. during the zero interest rate period, there was a 7-year period of zero interest rates before December 2015. Inflation averaged like 1.7% or something, monthly CPI inflation. If you look at after that, a similar period before this latest inflation, it still averaged a little bit less, like 1.5% as the Fed rose rates in the previous rate high cycle, not this crazy one. And so inflation is still crazy high. It's averaged around 7 or 8% over the past year. I don't have the number right in front of me. But so these rate hikes aren't slowing it down. The problem is the Fed more than doubled the money supply after the pandemic lockdown stock panic back in March 2020. And the money supply has still doubled. It's still 108% bigger today, the Fed's balance sheet, than it was in February 2020. And so if you have twice as much fiat dollars in circulation, prices should go almost twice as high, minus whatever the minor annual production growth is. And that's what we're seeing down here in America. We're seeing it in grocery stores and in every cost of living we have. Our rents are going up like that. All this money is still in the system, and rate hikes don't take that money out of the system. They do destroy demand. They hit interest rate sensitive debt finance sectors like housing and cars. But if the money's still in the system, then the prices can't fall like the central bankers want them to. Yeah. So anyway, that's where that stands, I think.
Considering that, let's say the Fed funds rate and CPI are getting close to each other, base effects, all that considered, do you think that the Fed, has the ability to get the Fed funds rate over CPI, considering, that is what is pointed to as Volcker's, win against killing inflation in the 70s and 80s. So do you think that they're able to maybe get to that point and bring inflation down that way?
I think they can actually absolutely get the federal funds rate above the CPI. But the big question for me is, can they hold it there? And I don't think they can. The CPI is interesting because there's been a disinflation trend over the past 7-8 months, which is awesome. That's good for everybody, right? Meaning that the numbers are lower. It's the year-over-year rise is dropping. But a lot of that's due to two factors, Tom. Number one is the base effect. The CPI numbers were so high a year ago that we have a higher base to compare them off of, so the percentage change is smaller. Number two reason is energy prices have fallen. I'm sure your listeners know the Biden administration released half the U.S. Strategic Petroleum Reserve last year, heading into midterm elections to help push oil prices down. And that pushed down energy prices. And we also have demand destruction in energy, which I'm sure you're acutely aware of in your neck of the woods up there as the economy slows. And so energy prices are falling. So if you look at the core CPI measures, like non-energy stuff, non-food, the inflation is much more sticky. And this is true all around the world, not just in the US. Canada's facing this, Australia, the European Central Bank and various national central banks over there. And so we're seeing headline inflation decline, which might allow the Fed to get the federal funds rate above the CPI for a short spell. But to be able to hold it there, and inflation could pop back up too if energy changes. If OPEC just cut production a couple weeks ago, and that might push prices higher. Who knows? But I think the Fed will have a really tough time holding CPI or holding federal funds above inflation for very long at all.
Mm-hmm. Yeah, there's just so many moving parts to try and pay attention to here. But Adam, I want to get your thoughts on, let's say, the differences between gold and silver right now, and if there's a difference in fundamentals between the two metals, or if they just move together mostly.
Silver's been awesome. It's been on a tear. I mean, it's had a much bigger rally than gold since mid-March, when gold really started moving in the spring rally timeframe. And one big reason for that was silver futures were much more extreme than gold futures. The silver futures guys, their longs actually fell to like a 7.2-year low back in early March. So super low, like everybody giving up on silver. I kind of view silver as a gold sentiment gauge, Tom. Like silver really starts moving when people think gold's going to keep rising. And obviously, silver has periods of time in history and it really radically outperforms gold. Gold's parabolic, goes vertical. Silver is just legendary for its crazy extreme moves. But the silver future situation was a lot more bullish than gold a month or so ago, and silver's rallied a lot more. But now the silver futures are about the same place. Like about 50% of spec longs have been bought. Probable spec longs have been bought. So silver should continue to outperform during the spring rally span. But like gold, it's going to have to face a pullback here sooner or later. Maybe in late May, maybe in June, maybe through the summer doldrums, as you talked about earlier. Mm-hmm. But yeah, so silver's been really great. It had better positioning going into this, but the futures buying is pretty much caught up there. And but I think gold sentiment is really improving. Having gold above $2,000 US has just been a huge boon for getting people interested in it. There's a lot of people who don't follow gold and silver, and so until you get a big round number in one or the other, people just aren't even paying attention. But once you have that, people start getting more bullish, thinking, oh, maybe I should consider allocating some capital there. And so as more capital comes in the precious metals, silver should outperform gold like it usually does during these kinds of times.
Adam, as you talk about how silver is maybe a gold sentiment gauge, how do you, let's say, separate the world of gold investing? Is there something we can learn as well from the ETF flows that could be helpful here?
That's interesting. I've done a lot of work on gold ETF flows relative to the gold price, and I've done some on silver, much less. But every time I've done it, every few years I revisit this, I find that there's not a correlation between silver ETF flows and silver prices. And I suspect the reason is because silver investment's more of a physical thing. Silver is much more attainable. It's a lot easier to go down and buy some silver coins and buy a gold coin just because of the amounts of money we're talking. And I think a lot of the silver guys are really, hardcore physical people, which I totally respect. If you have the metal in your own hand, no one can take it from you. It's much more safe than being in a bank or something. But so silver is a much more physical world, the investment standpoint. And I think silver has less of an institutional following. It's such a tiny market, just vanishingly small compared to gold. And so it's more of an individual thing. And yeah, so silver, gold sentiment definitely helps it, but it seems like there's less professional capital sloshing into and out of silver when gold moves. It happens occasionally when silver gets really hot, but for the most part, yeah, silver's smaller, it lags gold. It's more physical, it's more individual, and that kind of affects how silver acts relative to gold and its lag relative to gold and moving.
And how about the miners, Adam? We've seen some big volatility in many miners, and it almost seems like investors maybe don't believe the rally. They're cautiously dipping their toes in at this point. And, every other day, it seems like you get a good correction. So do we need more psychological barriers broken in the underlying metals price or the miners' momentum, let's say?
Absolutely. People are so down to miners. I've been in the precious metals newsletter business for a quarter century now, and I get emails all the time from subscribers and readers, and everybody's skeptical. Even after the big rally, GDX is up like 60% or something, 60, and people are still like, well, gold stocks have underperformed for X amount of years. They're going to underperform forever. No one's ever going to want to be in them again. And so there's a huge amount of skepticism. And I think we just need more time rallying for both gold and the miners. The miners have caught up a lot to gold in the past couple of weeks, and that's normal. As people start believing the gold rally will last, they tend to buy more miner stocks, but it takes time. It takes time to rebuild that sentiment, to build that bullishness. People have, I guess I could say, been burned in gold stocks a lot of times. There's been a lot of steep sell-offs, steep corrections. Mid 2022 was one. There was a huge sell-off in gold stocks because of that parabolic dollar rally on those extreme Fed rate hikes. And it just takes a long time for people to trust the sector once they've lost money in it. And gold stocks have a lot of proving to do after recent years of central bank machinations really affecting gold price negatively. Mm-hmm. And so, but that'll come. The higher gold stocks rally, the more people want to buy them, and we're seeing that sentiment is starting to turn, as evidenced in their outperformance of gold, which is really nice to see.
Adam, in your latest newsletter, you wrote about the Q1 results for many of these miners. So do you see optimization, let's say, in terms of production in the miners correlates to a rise in their share price?
I do. Absolutely. The main thing investors are worried about is production growth. That's the number one thing. That's what people really look for is growing production, because if you're growing production, you have more cash flow to expand your existing mines, buy new mines, do mergers and acquisitions, whatever you want to do. And the second thing to look at is costs. And, it's been a really challenging cost environment. Most mining costs are fixed, but there's still lots of variable costs. And the inflation has really pushed those higher around the world. And I think that based on what miners are saying themselves, like they report their costs every quarter. And they also do projections. Most of them do guidance outlooks for costs. And a lot of them see their costs declining and their production rising as this year marches on. Mm-hmm. And if they're right, if we have higher production and lower costs, that'll really boost their profitability and also boost interest in gold prices. The institutional guys, not so much individuals, but I talk to the institutional guys, hedge fund guys, normal funds, pension fund people occasionally. They really like to see stable earnings growth, and gold stocks really don't provide that. It's so volatile. Gold goes up, earnings rocket up, gold goes down, earnings collapse, but if we see gold stay higher, up around 2000 someplace or even higher, I think that earnings will really pick up this year and that'll attract in more institutional traders. Mm-hmm. But yeah, it's definitely looking up based on what the gold miners themselves are forecasting in their latest reports.
So when you're looking at a miner to possibly invest in or to start trading, I think there's an interesting difference there, right, in between those two terms.
Yeah.
What are you specifically looking for? We always hear, management, jurisdiction. Are there any, key factors to you that you need to see before you dip your toe into something like that?
Yeah, the number one for me, again, is production growth. I'm looking at factors that'll catalyze buying after me. I want to buy a stock that other people want to buy after me because that's the only way it'll go up in price, right? So I like companies that are doing big expansions that are going to come online in the next year, 6 months even. I like companies that have big projects, new mine builds coming live in the next year, just exciting catalysts. I look for costs. I want costs to be low enough so the miners are profitable. I look at market capitalization, Tom. Like the smaller a stock is, easier it is to bid higher. So if you have $1 billion gold miner market capitalization versus a $10 billion gold miner, and they have similar percentage growth potential, the $1 billion stock can be bid higher a lot faster and a lot farther than the bigger stock. And so the smaller market capitalization, generally the better. Not getting into penny stock stuff, but just we're talking mid tiers and larger juniors here. Uh-huh. Juniors defined as under 300K, mid tiers 300K to 1 million ounces of annual production a year. I look at price to earnings ratios, trailing 12-month forward. I like buying stocks that are undervalued. I look at technicals. I'd rather buy a stock that's beaten down, that's been sold off for some reason, rather than a stock that's gone up 100% in the past 6 months. Although I will buy those occasionally if there's a strong gold rally. But yeah, those are generally the things. I'm not as concerned about management as a lot of people are, but I don't dabble in the explorer realm deeply. If you have explorers, it's really important about the integrity of your management, because I think Mark Twain said a gold miner's a liar with a hole in the ground, right? I mean, so it's really important. A hole in the
ground with a liar standing beside it.
Yeah, exactly. So it's really important that you trust management for exploration stage companies. But once a company has a mine or two, they have an established track record and they're reporting publicly and they're accountable to regulators. And I'm more worried about other things than that. Usually the managers are pretty good at that point. Uh-huh. And so, but yeah, those are the things I mostly look at, and they've served us really well over the years.
Mm-hmm. Excellent, Adam. One of the things I've been thinking about lately is, let's say, the access to quality information. Where do you find good sources for where you base decisions upon, or let's say read every day, every week, something like that?
Oh, it's voluminous. It's like drinking from a fire hose, Tom. There's so many sources. I have CNBC on every day of my life. I get up early every morning and see what happened in the world markets. I have Bloomberg on. I read various newsletters. I really like newsletters. I'm in the newsletter business myself, as you know, and I like professionals spending 40, 50 hours a week, and then I can read their conclusions from all that work and that decades of analysis and wisdom in an hour or so. There's people in the industry I respect, newsletter writers, analysts, economists. It's just such a broad array of information. There's really no one source. Just talking with people, listening, reading, every second of every day I can, I'm reading about the markets, learning. It's my passion. And that's just kind of, if you're interested in something, you just want to learn more and more and more about it. And that's just, it comes from so many different sources. So not really good answer for you there. Sorry.
Not a problem. Well, I appreciate you sharing that passion and your analysis with us here, Adam. Is there anything else that you'd like to go over before we wrap up?
Gold's in a secular bull. Inflation is going to be here for a while because the central banks can't cut the money supplies in half to take out all that money they printed without crashing the economies, causing depressions, causing stock panics. Mm-hmm. And so what the rate of inflation might drop. Like we might go back to 3%, 4% growth, whatever, but the prices are still going to be twice as high as they were before the pandemic lockdown stock panic. And I think it's just an incredible environment for gold. I think people are going to increasingly realize that central bank rate hikes are not returning prices to normal. When the guys on TV talk about inflation, they're usually talking about the annual increase. They don't care how high prices are, absolutely. But as ordinary everyday people, we care how much we have to pay for groceries and gas and rent and college and insurance and everything. And I can't see those prices going down ever if the money supplies stay, roughly doubled around the developed world. And therefore, I just think gold's an amazing investment. Yes, we'll have a pullback correction after this spring rally, after this up leg, but bull markets are a series of up legs followed by corrections. No big deal. So I encourage your readers to stay informed, just to watch the sector if they're interested, and buy at the corrections, after the corrections, and prices are back down there near the 200-day moving averages. Ride up the next up leg. Ratchet up stops when prices gets too overbought, stretch too high above those 200 EMAs, and you can just make tons of money riding those up leg and corrections. You don't have to catch them all. It's impossible. But say you can catch the middle 80% or 75%, you just make a fortune over time. I just can't. It's hard for me to imagine the secular gold bull being anywhere close to over with the money supply is so inflated and central bankers just impotent to be able to take those down. So I think that we have a long way to run, years yet, for this secular gold move.
Mm-hmm. Yeah, I think that's a great way to kind of summarize everything. And, it's an important point too, is that, if we see the CPI rate coming down, that just means the growth in the prices, not necessarily even that prices are actually coming back down, right?
Absolutely. Yep. And there's a huge distinction. It just grinds my gears when the guys on TV, the analysts always say, well, inflation's 2%, we're back to normal. No, we're not, unless prices are back to where they were before the money supply doubled, and they're nowhere close, as and everybody else knows, is trying to live in this crazy world.
Yeah, absolutely. Well, Adam, I really appreciate your time and sharing all your thoughts with us. And I think your website, everybody should check out. It's a great resource. You do some excellent writing on there, zealllc.com. Anywhere else you can point people to, or you'd like to?
No, just stay informed. Spend an hour a week. If you're interested in the market, spend 1 hour a week reading something. It doesn't have to be my stuff, but just stay informed. People tend to not stay abreast of this thing. And if you don't stay abreast, you're going to miss the buying opportunities, because the time to buy any sector, gold stocks, anything, is when it looks terrible, when there's been a sell-off, and people tend to check out when prices start going down. And that's when you should be really engaged. Just spend an hour a week on this. Read someone you respect, you like, and you'll gradually start making money in the markets if you stay connected. So,
yeah, absolutely. Adam, thanks so much for your time and sharing your thoughts with us today. Really appreciate it.
Thanks for having me, Tom. Have a great day, man.
You too. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.